In 1929, the crash wasn't a singular event. It was a total psychological breakdown of a market that believed in its own immortality. Today, we're auditing the current AI bubble against the historical DNA of the last 100 years. This session is anchored in the true Main Street meets Wall Street fashion. I've distilled the structural lessons from every major economic collapse since 1907, from the panic of 1907 to the dot-com era, and layered them over a 33-minute raw breakdown at the current SaaS-off. That's at the end. We're going to start off with a conversation with Adam Parker from earlier this year. Full conversation people have been asking for part ones and part two. See how this actually plays into the Moore economy. A lot of things that he said have come true or come to fruition and approaches to your market and your portfolio. This one's full of value. Can't wait to get back to it. Thanks for joining. Hop in. Here we go. Main Street, when you hear the noise and the news that's happening, it can be as confusing as that great scene from My Cousin Vinny. Welcome to Main Street Meets Wall Street, a podcast that helping Main Street meet Wall Street with financial information, financial literacy. Honored to have Adam Parker on here today, coming to you from Wall Street South down here in Charlotte. Today, we're just going to jump in, let Adam talk about a little bit about all the information just came in today. A lot of stuff just happened right before we hopped on. We even just got off a call with a journalist from the Charlotte Business Journal talking about SCOTUS and tariffs. We'll let Adam tell you a little bit about how his industry and his firm can't be disrupted by AI, how it's actually a tool. And then Adam will tell you a little bit about himself. He's a Tar Heel, so I'm glad you didn't say you went to Duke because we probably couldn't have done this call. So without any further ado, here goes Wall Street. Here's Adam.
Hey, Marcus, thanks for having me. And for those listening, we do have a financial insights newsletter we publish. It's called Trivector Research, TRIVECTOR, like magnitude and direction vector. And you can just go on. We do monthly Zoom so people can ask questions. We do ETF analysis. We give people, advice about staying fully invested in the equity market or other kind of big picture items, sectors that we like, industries we like, et cetera. So sign up at our website. And if you say you know Marcus, you get 1 month for free. So that's no problem. So yeah, trivectorresearch.com. Check it out. So I guess you want to talk about my background, or what do you want to do, Marcus?
How about you talk about? You said you just had meetings this morning. What is institutional money talking about right now? Right? What's Wall Street talking about versus Main Street?
Our other business, Trivariate is our core business. We sell research, insights, events, bespoke services to institutional investors, asset managers, hedge funds. And I was just mentioning to Marcus, nobody's really asked me about the tariffs today, despite today being the day of the, kind of a Supreme Court decision. I think it's kind of in the price. I don't think people expected, much that's different. So the market's rallying a little bit, kind of viewing this as maybe there's some costs that can go away for businesses. Maybe there's not, but I don't think people view this as a very big incremental. Most of the things that people are talking about in the meetings are around when will we see more proof cases for AI productivity? I think the expectations for earnings are more than 15% for the S&P 500 this year, 15% earnings growth. And so I think people are saying, well, wait a minute, that's embedding some AI productivity and cost cutting from the companies. Are we going to see that in the next couple of quarters, or are the estimates too high? Definitely that's one area. Two is software. Anyone who's owned software stocks in the last few months has seen some pain. So people are trying to figure out, are we near a bottom? Ideas, which ones do I buy? I think semiconductors always come up in the meetings. I used to be a semiconductor analyst, so I think maybe the questions I get over-indexed toward that sector, but for sure, the S&P is probably 60% an AI ETF at this point. So a lot of it comes down to the semi cycle. And so people are trying to figure out when maybe the memory trade ends. So SanDisk, Western Dig, Micron, et cetera, and maybe when they should be rotating into other stuff. So those are more the questions I think right now, as opposed to, policy at the presidential or Supreme Court level.
Gotcha. Yeah, I think, like you said, the market pretty much priced in these tariffs or the decision from the Supreme Court. In your research, and I know with all this being priced in already, have you already accommodated for the tariffs? I know we have 15% earnings growth projected this year. This earnings season was actually pretty strong, and the markets didn't respond as you would expect them to with all the micro and macro data that came out.
Yeah, Marcus, to get the stock market view, there's two things. There's the price to earnings, so that multiple you're paying, and there's the underlying earnings itself. And I think coming in this year, our view has been it's going to be not that likely that the multiple or the price to earnings expands. I think the earnings are growing. I don't think they're going to grow 15%. We think 10% is a better, safer number. But if the earnings grow 10, you would say normally the stock market would go up. And I think it could go up. We're kind of thinking flat to up 10 makes more sense than the double-digit returns we've seen the previous 3 years, just because I don't think that price to earnings is likely to expand. One, the Fed, at this point in the Fed cycle, you're going to get less boost from them cutting. And eventually, if they cut a lot, it's because things slowed a lot, not just, oh, great, there's a combination. And then two, I think people are probably maybe underestimating that whether margins can go up for companies, because margins are affected. Sure, they're helped if tariffs come off, but they really matter more on pricing. If you could sell something at a higher price and not lose any units, that's great for your margins. But I think it's getting increasingly hard for you. There's lots of anecdotes I could give people from companies, but my favorite current example is Doritos and Lay's are going to be 15% cheaper. Okay. I don't know many of us have gotten to the impulse purchase and been like, ooh, I'm not going to buy this but it finally got to the point where they took pricing to the point where it started hurting demand. So I think pricing is going to be an issue. I don't think the average company is going to see gross margin expansion. I don't think the Fed's going to be as helpful for that price to earnings ratio. So when I multiply the earnings side and the price to earnings, I come out a shade more cautious on the equity view than the consensus, which I think is just super bullish. And I'm a little bit more worried about the consensus.
Got you. And the way you broke it down when you mentioned, first of all, with the chips, they might get cheaper, but is the bag going to get smaller? Or are they taking a few chips out of there, shrinkflation,
Shrinkflation, yeah,
shrinkflation.
exactly.
But and then also shrinkflation, talking about all this free cash flow that is being affected by the capital expenditures being used by these hyperscalers now, right? Not even so much in the software as we've seen software flush out, and they've started to make these announcements, but we've seen, like you do semi, so we've seen NVIDIA be range bound for the last, since November. It hasn't really done anything. It's gone up, it's gone down. It can't really go through 200, it seems like. Like that's where it seems to get stuck. And I haven't looked at the market today, like since like right before we got on, but I don't know where it's at. But in that sense, how do you see these companies growing out of this if you're seeing margin
Yeah, I
expansion?
mean, look, the market, there's AI revenue beneficiaries, right? And NVIDIA, obviously, having been a monster stock from 2023 through late last year, was a primary revenue beneficiary. But I think the market's transitioning a little bit to who could the productivity beneficiaries be? So who can drive out costs by predicting their employee behavior, their customer behavior, maybe growing the revenue without new hires or net hires, and then margins can go up. And we've seen that from stocks like Walmart and Costco, where they're low margin businesses, but if people think the margins are going higher, they traded very high price to earnings ratios, 35, 40 times earnings. So people are sort of transitioning away from the revenue beneficiaries, thinking that's more in the price and trying to find inefficient businesses where maybe the margins can go up. NVIDIA could still be a fine stock because it grows, but I don't think you're playing NVIDIA for multiple expansion and the growth. You're saying maybe the multiple continues to slightly erode, the earnings grow, and it can go up at a market rate. If the market goes up, 8% a year for the next few years, sure, NVIDIA could go up that much too. But I don't think people think there's as much upside because it's hard to sketch out their enterprise value to sales goes up a lot.
Yeah, law of large numbers when you get to those type of things. But even
Yeah, it could be, but I think it's also just that they're probably over earning a little bit. And so, the space they're in is competitive and you're not going to pay a higher multiple because you're just worried that eventually they'll lose share on their high margin product. So I'm not negative on NVIDIA, but I think you have to find companies that can benefit and drive costs out because stocks go up when their margins go up.
right. So a company like Intel or TSM, like Intel actually had a crazy year last year. People didn't really speak about it. Like it went way up, but obviously it had privatization from the government, different things. They want Intel to succeed. Like it's good for American business. I'm doing air quotes for those listening. But inside of that, so you see a shift back to the older companies, probably stocks you were covering before, like Cisco, Intel, but TSM, everything's built on these stocks. And then you mentioned Costco's and Walmart's. People, all this seems like the shift to the old stuff is a cyclical shift back to value because these stocks are value stocks inside of these high growth IBM companies like that. So inside of all of this, how have you seen? Because there are people, like you said, you're a chip analyst. There are people who are only going to invest in chips and they can't invest in NVIDIA right now per se because they don't want to see 8% growth. Where are you seeing the shift inside of chips?
Yeah, I mean, so it depends how nuanced you want to get, but the semiconductor industry has lots of different business models. There are companies that make very inexpensive chips that go in every industrial application, in autos, in
Texas Instruments.
doors, yeah, Texas Instruments, Microchip, Analog Devices, etc. Those businesses had really underperformed for a long time because they had very high inventory after the COVID, and you started to see them act really much better over the last few months as they kind of predicted a slightly better industrial environment as they cleared out some inventory. Those businesses are different because if they overbuild, the pricing on the inventory doesn't go down. So just to make sure everyone understands, if I sell a $2 converter, maybe I sell $22 converters into the cockpit of a Caterpillar dump truck. It's a $100,000 dump truck. Actually, it's probably more, $200,000 dump truck. Me cutting my price from $2 to $1.90 for each of my 20 converters is not going to stimulate anybody to buy the dump truck. So if the economy slows and there's no dump trucks being bought, I just take my extra converters, I stick them in a warehouse, and eventually when Cat reorders more dump trucks, I just can still sell them for the same $2 that I had produced them at. So that business doesn't see huge fluctuations in their gross margins. They don't see huge pricing degradation because the value out of the product is high and the percentage of the bill of materials of what it goes in is low. On the flip side, memory, which is a completely different business, solid state stuff like Seagate and Western Dig, or classic like DRAM like Micron makes, these stocks have gone parabolic. They were all among the best stocks in the S&P last year and again this year because there's a shortage. But when they overproduce, their pricing will get decimated and it will go down 90% more because when they overbuild, in order to clear out the inventory, you have to massively cut pricing. And their product is a big percentage of the bill of materials. So what do I mean by that? Let's say it's a $1,000 Dell desktop that's got $200 worth of memory in it. You know, if memory prices go to 300, Dell can't afford to not raise pricing from 1,000 to 1,100 for the box. They have to capture some margin. And so that higher price actually cuts demand. It hurts demand for the PC, right? Because it becomes too expensive. So memory isn't anywhere even in the same category of business as, say, what the analog businesses do. And then there's the companies that make the processors, NVIDIA, Broadcom, Intel, AMD. And then there's those that make the equipment that produce the semiconductors. So Applied Materials or AMAT, KLA, KLAC is a ticker, Lam Research, Testers, Teradyne, et cetera. So they probably, memory is one of their customers. And so if memory rolls over, their stocks could be hurt, but they actually are a lot cheaper in absolute terms and are over-earning a little bit less. So I think you have to kind of parse the industry in a bunch of different buckets. Marcus, I probably answered too long-winded of a question, but to me, I think you have to be careful. And I think the more memory goes up, the more you should want to sell it, not chase it, because they are over-earning and the stocks definitely will see a huge correction at some point in the next 12, 18 months.
Perfect. No, you definitely did not go too long in that answer.
Don't like it.
You can speak longer if you like on that. No, it's a good explanation because I don't think people realize, like you said, you can have one component inside of a $200,000 item that's only $2 goes down to 190. Even if it went down to like 150, right? And they can just put that inside of their
It's irrelevant. Yeah.
yeah, they can
Exactly.
put that on the warehouse. So with that side, it's more about the orders, right? The demand, like what are you, like when you see
Exactly. The
something
industrial economy
expanding,
picking up.
what are the orders, right? But with memory, it's more
It's a
about the
shortage.
availability.
Right.
Would that be a good analog with
That's
that?
right. Yeah, it's a shortage. It's a shortage that, and so that when they finally get demand growth slowing relative to supply growth, then the stocks get killed. So I think the problem with these things like Micron is, you know, it maybe have 50% upside, but they also have 50 or 70% downside. And so when you look at like risk reward and up to downside ratio, you know, stuff that's got 50% upside and 50% downside is a little less attractive than something that's got a lot more upside than downside. So I think you got to be more careful with the really cyclical parts of the semiconductor industry.
Gotcha. It's a great explanation, man. Great explanation. I want to transition a little bit into, so we've seen this rolling, I would call it a rolling recession, like inside of sectors as things come in and disrupt different industries. You know, you had to come in with the fintechs, with Altruist. I use Altruist as a custodian, full disclosure. So shout out to Altruist and Jason Wheat. Look, they're great people. Hazel, that disrupted the industry. We had what do we have? A karaoke machine disrupt trucking last week. Like people are just trying to pick what's next inside this industry, what's going to be disrupted next. Somewhere in that industry, research has to come in, right? How does your business not get disrupted by AI?
Oh, what we personally do at Trevariate?
Yeah.
Well, it could. I mean, look, I think it's healthy to have some paranoia, and I will go as far to say is if you're not worried about being disrupted at all, you're probably a psycho. I mean, like, you should have some doubts about what you do to motivate you. I guess I'm 56 years old. I've been doing this for a long time, so if I get disrupted, I'll probably just learn how to play pickleball or something. I mean, but I think if you're younger, you have skills that are differentiated, and make sure that all the guys who work for me on the research side are, expert Python programmers. They're really well versed in natural language processing. We're trying to, the reason our institutional business is called Trivariate, in our retail business that I mentioned is called Trivector. But the reason it's called Trivariate is three variables: macro, quant, and fundamental, applied to U.S. equity. So what I try to capitalize on the fact is that I have a PhD in statistics, which I think is a somewhat differentiated skill. And I was a number one I ranked semiconductor analyst for many years. So I had a lot of experience as a fundamental stock picker, and I worked at a well-known hedge fund that is a bottom-up stock picking firm. And, then I was a U.S. equity strategist at Morgan Stanley's most read research product at the number one equity business in the world. So that was kind of the side. I sat on a 7-person asset allocation committee for the 17,000 financial advisor network. At that time, it was only $2 trillion US dollars under management. It's bigger now because they bought E-Trade and other stuff. So I have experience doing like kind of quant, fundamental, and macro. And so I think part of what I'm trying to do is puff a few less puffs on that cigarette of my career by combining those three things. But, I still think you have to worry about it. And I think for me, the advantage is just we have tons of institutional relationships. And it's funny, somebody the other day asked me, "Oh, what do you do for a living?" And I said, "I sell research on the U.S. stock market." And they laughed at me. They thought it's just so impossible that a normal human being could do that. But they didn't know anything about the fact that I just spent my whole career doing that. I think in terms of the AI implementation stuff, though, Marcus, like taking your question more seriously is, look, we spent a lot of time doing that. I published a research note for my institutional investors this week where we took every word I've ever written and said, put it in Claude and said, is there any kind of sentiment that's coming from my words that actually has predictive value? And we found actually there was kind of a 1 week predictive value. When we said more negative things about the market, on average, the market did worse the next week than we said more positive things. So I think that's because we're reflecting the questions we get from our institutional investors. We do whatever it is, 16 institutional investor meetings a week or whatever the average is over the year. It's hundreds of meetings. And so at the end of the day, I think at some level, we're reflecting the good questions we get from investors and trying to react to new information and new news to figure out where our mind's changing. The older I get, the more I realize that like I have to unlearn things, or things have changed, or I have views now that I used to not have. Like, for example, I don't think valuation works to pick stocks. We can get back to that, but I think you have to always evolve your thinking. And if you're not at least somewhat open to that, then maybe you're more vulnerable to being made obsolete.
Perfect. So it sounds like for one, well, maybe you sound like you're on the back 50, as my stepdad likes to say. You're on the back side of 50. But two,
56. I'm gonna get close to 60.
Hey, that's 60 is the new 20. Look at Bill Belichick. I probably shouldn't have said that. But you're embracing AI, right? Like, that's what you're saying. Like, you're embracing AI. You have guys.
We bought an NVIDIA chip 3 years ago, put it out on EQAX, the public data center read. We have a very quantitative firm in terms of how we do process. Every day for the biggest 3,000 U.S. equities, we download or compute hundreds of pieces of information, and then we use that to empirically test outcomes. And that's part of where the research on the institutional side started. The reason we started Trivector Research is because, I felt like we needed to help advisors and individuals more. I'm a CNBC contributor. I'm on once a week. People come up to me all the time. Hey, how can I access your stuff? And so the problem with the Trivariate institutional business is we sell it for hundreds of thousands of dollars a year. So no normal person is going to buy it. So we started Trivector because for $100 a month, we can give them more practical advice, why they should save, fully invest in the equity market. How do they think about, cost averaging new investments, what they're actually getting when they buy certain ETFs, because they don't actually always give them the exposures they think,
IGV.
that kind of stuff. Yeah. Comparing ETFs, that kind of stuff. So I think that business is kind of born out of just capitalizing the database we have. It took us 9 months to build a database. It's the 4th time I've done this in my career. We spent several $100,000 a year on data for the database. And then we're using a lot of technology to kind of quickly process information. So I'm hoping there's some harder to crack edge by all that investment. But your question's right. People should worry about that. And we're very open to embracing technology for sure.
Excellent. And so as we continue the journey and we're talking about AI, so you mentioned that it took you 9 months to build up your database, and you mentioned
That's a couple years ago,
you analyzed, and that was a couple years ago. So compared to then, like when you had to do some research back then, like you were writing a weekly newsletter or putting out weekly research, how long would it take you to do that then compared to with AI now? How long does it take you now? Like how much does AI increase your productivity? How do you
Well,
actually use it?
I mean, I just maybe a fair thing is like when I was a U.S. equity strategist at Morgan Stanley, I had 9 senior people in New York and 4 people in India on the team, and now we have 4 people spread around the U.S. on the team, and we produce way more today than I did when I worked at Morgan Stanley. We can process information more rapidly and assess more. I think the challenge for me actually, Marcus, is that it's one of my 27 weaknesses is I always say yes when one of my friends or clients says, can my niece, nephew, kid work for you as an intern? And the problem is no intern can add any value anymore because all these kind of Gemini and ChatGPT and Claude are like having a million interns. So it's hard to come up with projects where a young kid can add value. And I used to be able to, give them projects. Hey, tell me what all the acquisitions and divestitures Microsoft's made in the last 10 years and what technologies they're buying or investing. And they would go away for 2 weeks. But now they come back in like 15 minutes, right? Because ChatGPT is pretty good at that stuff. So we're constantly trying to figure out what we can use interns for. And that process leads me to a lot of it's in the natural language processing work and trying to figure out like where there's errors or where there isn't. We search every earnings call transcript and we really look for information there. And it could be anything related to AI or cost cutting related to AI. And then once we cluster the stocks, we then say, are they even seeing better revisions, higher multiples, outperforming? Are there any like tangible evidence of AI implementation? Because we spend a lot of time on like who's going to be disrupted by AI, who's impregnable to AI, who's a beneficiary on the cost side, because stocks that are getting more expensive are really just stocks that are more likely to benefit from AI or be impregnable. And stocks that are getting cheaper are really just stocks that are more likely to be disrupted. And so if I use mean reverting valuation to buy stocks, I'm just buying companies that have a higher probability of losing and selling stocks that have a probability of winning. And that I don't like that idea. So
I
we
mean,
use
so
AI a ton all day, and it's massively increased productivity. One way that the normal people listening wouldn't appreciate is data ingestion. So if you buy data, it can come in all kinds of weird forms and columns and semicolons and all over the place, unstructured. It could be videos or it could be photos or whatever. And it used to be you would spend a lot of time formatting the data before you could even read it in and analyze if there's any information in it. And the AI tools are really awesome at data extraction and ingestion and save tons of time on that. I'm sure some of you've used that. I don't know if you've even used that in a very basic way in your personal life, but like, have you ever tried to email 25 people at once and there's like semicolons in between them all? Just you tell it to get rid of some, whatever, stuff like that, but multiplied by 1,000 or 1,000,000 for big data sets. It's really efficient on that kind of stuff.
excellent. Yeah, that's very cool. And I want to ask you another question as far as how is this disrupting with like interns? Like I know you said with interns, those are free jobs. So like people coming in from the industry, entry level. Like I would imagine if you're coming into the industry now and they're training kids in AI, people have AI courses in college. So you can come in with like an AI degree, or you can come in really training AI. So you don't need an entry level job. Is that affecting like how you're hiring people? And then I want you to go into like for Main Street, like the breakdown between like what the actual analysis is, technical versus fundamental.
Yeah, sure. So on the what's I'll do that first part first, and then maybe ask me the second part, so I don't get too sidetracked. But you were
Okay.
saying like the hiring stuff. Like, look,
Mhm.
I mean, I took an AI for healthcare course at MIT in the summer of 24. I was really interested in applications for healthcare. I learned a ton, but honestly, we're headed to an era where everybody's going to be a programmer, right? Where you'll be able to just tell your box, hey, I'd like to see this. Can you write the code that does this? And it will probably be able to do that. We're probably 3 years away from that.
3 years.
Or, well, I mean, for people who don't know anything about coding, it's already open source and really efficient on writing new code. And our team like is really good at that. But like, look, to me, um, the way I the people that we hire, I mean, I have a small firm, right? So what can we offer? Content, they have to like doing analysis on the stock market. People, they have to like the people they're working with and for and interacting with. Autonomy, so the ability to think about what they want, when they want, or maybe control their own schedule. Um, and then, some area under the curve to make money. And then the last thing people care about is brand. So like, we don't have that, right? So if you're somebody who's like, I got to work at Blackstone, I got to work at KKR, I got to work at Morgan Stanley, then what do we offer versus them? We could probably pay more. They get to interact with more senior people than they would if they worked there. And they have a little bit more control over their life, meaning, at the big firms, you say, my brother's getting married in a month. Can I have off on Saturday? And they say no, right? So like, there's a little bit more schedule, but what we don't have is brand or whatever. So like, we sink into the fact that you're going to interact with senior people more, you're going to learn more, you're going to see more clients, and we could pay just as well or more. And so I think that's usually enough for people. But people want brand, or they want a big kind of class of people that they can interact with, then that's not what we can offer. So it starts with the human stuff, Marcus, on the hiring front for us. And then the AI skills, like I find, I'll tell you a funny story. When I was at Morgan Stanley, I had this incredible woman who worked for me with the greatest resume I've ever seen. Okay. I mean, this woman went to, went to Yale, was a Fulbright scholar, spoke fluent Mandarin, but she was Caucasian. She went to Yale Law School. I mean, this was incredible. And she left, and I was bummed. And so I told the HR team, I wanted someone who went to a not very good college and had not very good grades. And she said, what do you mean? I said, well, I want someone who's hungry like an animal. Okay. And the problem is we only hire people who went to the top universities and got great grades. And so they all want to, be senior when they're junior, right? And I went to Michigan. I went to the University of Michigan undergrads. This is a joke. I don't want to offend anyone who's listening, but I said, I want someone who went to a bad school like Michigan State. That's a rivalry joke. It's like a UNC Duke joke or whatever. Okay?
Right.
But my point was like, we don't recruit at Michigan State, right? We only recruit at Wharton and Harvard and Chicago and Stanford, right? So like, give me someone who went to a totally fine university, but just not one of the best ones. Okay. And then I prefer someone who had bad grades. So he said, so what do you mean? I said, what I mean by that is I want someone who was like a track star or a musician, someone who was great at something, then like broke their ankle. And so they had like C's their first 2 years and A their last 2 years. So they show them the aptitude, but they present themselves as someone who had B's from Michigan State, like somebody we would never hire under any circumstance at Morgan Stanley. We don't hire people who have B's at Michigan State. We hire people with A's at Wharton, right? But I wanted someone who was an animal, who was like, I'm going to come in and I'm going to work my ass off because I'm going to prove to you that I belong. And so to me, you asked me a question about hiring, like that's what I look for. I look for the person with a story, an aptitude, who's an animal. Okay. And I don't want them to be, there's nothing wrong with someone with great grades from a great university, but I found the distribution of outcomes is skewed to the negative for me at my firm.
Yeah, so the pedigree is really important, right? Like, not important in the pedigree. What you want to have is the hunger and the chip on the shoulder. I'm sorry, not the pedigree. The chip on the shoulder.
I met a guy. It's funny you say that, Marcus. I met a guy. I also never told this story. And I do millions of podcasts. I've never told this story. I mentioned the phrase chip on a shoulder to a guy, and he pulled his shirt back, and he had a tattoo of his chip on his shoulder.
Excellent. Did you hire him? Did you say come?
I made him an offer, but he turned me down.
Now you got a chip on your shoulder from that. That's pretty cool. Never heard before, Main Street. We let it out.
So then the second question you asked before was, I'm trying to remind me.
The second question was, so this is more for like Main Street literacy, financial literacy. How people say, you'll hear people mention technical analysis, fundamental analysis. First, explain which one you're doing, and then explain the difference between the two.
Yeah. So I think for technical analysis is, people say, well, I look at the chart, right? They try to figure out either momentum, things that are going up, continue to go up, things that are going down, continue to go down, or mean reversion. They think it's going down, it's going to go back up, or it's gone up and they think it's going to go back down. And so it's all looking at charts and recent price action. It's price action only. Fundamental analysis is much more digging into what a company does, how fast can it grow, what products do they sell, what pricing do they sell it at, to their peers, what are their margins, what are they doing, are they good stewards of capital when they make money, what do they do with it, do they do a dividend, do they buy back stock, do they buy other companies? So fundamental is much more kind of an assessment of the business, its strategy, are they implementing it, and technicals is much more just literally looking at the stock price and guessing on whether or trying to predict whether the trends on the price will continue or not. Ultimately, in some cases, they end up correlating. A business that's doing well and gaining share and growing fast and expanding its margins tends to have a stock that goes up, and the technical guy picks up on that and buys it because the chart looks good. Or so they're not completely unrelated in terms of how maybe stock behavior is ultimately, but in terms of how people come at analyzing things, they can be completely different. I mean, technicians might not care at all about when the company reports earnings, or that, if they're good stewards of capital, the stock went up and they want to buy it because the chart tells them it looks good. That might be all they care about. And they typically would have a shorter investment horizon. That technician, they probably would buy something for a few weeks or days, whereas usually a fundamental person is saying, I think this is going to be a good business and I could hold it for 6, 12, 18, 24, or 36 months.
Got you. So it sounds more like a technical trader, a technical investor is more trading tendencies. But you were mentioning when you were speaking about fundamental, when you were mentioning analysis, your fundamental analysis, you were describing bottoms up. It's also an approach from like top down, right? Where you look at the whole industry. Do y'all take the bottoms up, where you go from the company from the bottom and analyze it that way, or do you take a top down approach? Top down.
So we try to do both. I mean, we don't have like price targets and earnings estimates for individual names, so it's not bottom up that way. But we look at every company, analytically. So it could be where the margins forecasted to expand, or where they forecast to expand more than their business model average. So we're always trying to like search ideas. I mean, what we kind of focus on in our core business, institutional business, is risk and risk management. Their equity portfolios. We do custom work there, idea generation. So the ideas are where we think stocks could be outperform or underperform, tech strategy. So we do a lot of work on tech, on technology companies, just because the S&P 500 is just so filled with tech stocks at this point. We do a lot on like management decision making, so analyzing the deals and buybacks and dividends and those kind of things. So the institutional crowd's very focused on that. I think for Trivector Research, where your listeners hopefully go to the website, there it's going to be much more big picture things, like what do we think the S&P can do per year for the next 5 years, and why you should stay invested in the S&P, and what are the sectors and industries that we think have better estimate achievability or not. So it's more bigger picture things. Most institutional investors, they run big funds, and they're not like looking for advice about should they buy equities or not. It's kind of a different animal. So, but listen, for $100 a month, anyone can just go to Trivector Research and check it out.
Got that right. And we'll put the link in there. You said use Marcus, you get a month free. I don't know if that was
free.
free.
Yeah, that's right.
But yeah, we'll put it in there. We'll definitely share it with our listeners and viewers alike. Yeah, it's good stuff. Very good stuff. So now, folks, when you hear people speak of research and you hear people talk about those type of things, Adam has broken down for you. Adam, I want to transition a little bit more into more about you, man. We were talking earlier offline about, you said you did your post-grad down here in Wall Street, South Charlotte, but you did at Chapel Hill. So tell me a little bit about that and what you saw literally with financial literacy. That's one of the big reasons for this whole podcast.
Yeah, I guess the root of that is I did a master's degree in something called biostatistics, which, back then, I was in Chapel Hill from 1991 to 1993. Really the only places where there were a lot of data were basically the credit card industry and healthcare. And so in the time, a North Carolina-based company called SAS Institute was the software folks used to ingest and analyze data. And I was a statistics major in undergrad. And so I thought, this statistics applied to medicine, public health could be interesting. And so I got free tuition and a stipend to teach undergrad calculus and study in Chapel Hill, and ended up doing a PhD in statistics. But I never came back to UNC from when I was 24 years old till I was about 40. And I got a call when I was a U.S. equity strategist at Morgan Stanley from some fundraising guy in my early 40s at Morgan Stanley. And I thought, I wonder why they waited to call guys who graduated 20 years ago and live in New York City this long to ask me for money. Because normally in New York, you get asked way faster.
So I gave slower down here in the South, Adam.
I gave some money. I don't remember, but I gave a few bucks. And in my mind, it wasn't very much. And I thought, I'll probably never talk to this guy again, but good for him for hustling to call, young kid. See you later. But evidently the amount I gave for public health was a lot. For Wall Street, it was not. And so fast forward, I flew down, I started meeting some of the professors, whether they're in maternal and child health or environment or nutrition or health policy or health behavior or whatever. And I really found it uncorrelated to what I did for a living, interesting and rewarding. And so fast forward at blah, 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 I ended up, being the chair of the board of the Gilling School of Public Health at UNC. And it really gave me a window into a lot about public health. And then in particular, it's a global school, but in particular, obviously a lot of knowledge about North Carolina and, and it's a very interesting state. As I started to tell you, Marcus, you got very high churches per capita and a lot of people who rely on the church for information. You got a lot of people who don't have access to, fruits and vegetables and clean water and, good, maternal health advice, and then you also have like very rich people. So it's and then you got very different in the western part of the state is very different from the coastal part, both topographically and politically and, in every way. So it's a super, I think a great thing you're doing to try to get people's literacy up. And, I think generally the stock market's complicated and you're competing against incredibly smart people with lots of money and resources. And so you want to make sound decisions. And I'm a little worried about young people in particular who tend to put too much of their wealth in one particular, they don't have any wealth and they make huge aggressive bets into crypto or one stock. And they end up with, kind of a view that it's that easy to do things. And honestly, I don't think that's a prudent way to accumulate wealth. We do on the Trivector thing, we talk a lot about taxes and we talk a lot about fees and other things that I think can really eat at somebody's wealth over time. But for those listening who are just starting on their financial literacy, I would be consistent about it. I would try to put a little bit of money each month into some really low fee S&P long only fund. I would try to maybe trade a little with a small amount of money just to get used to it and then some low fee account. But I would not put all of your money into some fart coin or whatever and pray that it goes up. I think that's not a good way to establish, discipline in your career.
Man, that's great advice. Speaking of retail investors, you didn't particularly say this, but you said younger investors. You deal with institutional investors a lot. And I know that for a while, institutional investors just kind of laughed at retail investors. But if you look at like last year in particular, retail investors carried the market. Every time it went down, they went and bought the dip. And people just kept saying the retail investors are dumb money. How is that like the change inside the retail investor, the amount of money they've been putting into things? You saw a lot of it with like the Robinhood trader, quote unquote. Anyone not institutional, how's that influencing maybe even your research and how institutions are talking? Or they're starting to take notice?
Yeah, for sure. I mean, well, our clients include the large, private wealth networks, so the biggest ones that are almost like institutions, all of them are Trivariate clients. And then obviously individuals, advisors there could also be Trivector clients. So but you're right. I mean, the retail money was steadier, certainly in the March and April lows from 2025 and the real acute fears on tariffs. But I think the way money is run now is different than history, right? Like so much more money is run high frequency. I mean, I'll give you some interesting data. I think something like 70% of all of options today are 0-day. And something like 70% of all 0-day options are retail investors. So
say all those numbers again real quick.
So 70% of all options are 0-day. So they expire at the end of the day. And 70% of all 0-day options are retail. So 49%, 70 times 70 of all options are retail investors 0-day. So you got a bunch of people out there who are making options bets between now and the close. I don't think that's a great way to accumulate wealth, and I think it's highly risky. But it's just an example of why you see really volatile performance in and around earnings reports. And I think institutional investors that are used to lower turnover are, seeing and observing a lot of that. There's a lot more ETFs than there are stocks. There's a lot of levered ETFs. And so you can see big moves in stocks that are, in those ETFs, whether it's Palantir, NVIDIA, Tesla, whatever. And I think the third thing that's probably underappreciated is just the way quantitative money is run. So most quantitative money is run where there'll be a lot of leverage. So what that means is, let's say I'm running $100 million in my quant fund. I might have access to running it at 10x, or now I'm running $1 billion because I can borrow money from the prime brokerage firms and lever the bet. So now I might only be running 100 million, but really my balance sheet's $1 billion. And there might be 35 guys like me at one firm, and there might be 30 firms like mine.
1929.
Right, these guys run hundreds of stocks, long and short, with a very short investment horizon, 3 hours to 2, 3, 4 days. And so their impact on the market is massive because
Mhm.
there's all these firms that are huge: Citadel, Balyasny, Millennium, Schoenfeld, LMR, Bullridge, Volition, Cube, point 72, whatever. Cube. There's a million of these firms, and they all have 25 or 30 teams that are running money quantitatively, and they all have a 3-hour to 2-day investment horizon. And so sometimes they purposely don't play when the company reports earnings. They're only in when it's not earnings, price, liquidity, whatever. So the impact that this has in the market is also enormous. And so I think if you look at the quant money and the retail money with the 0-day options, like those are things that weren't the case 10, 15 years ago that are impacting a price discovery all the time. And by the way, these people are doing incredibly well and making money doing it. So it's not like, some of the smartest people in the world with the, best access to information that are doing that. So it's just a dynamic you have to deal with. And if you have a big asset pool, permanent capital, and you care about taxes and you care about fees, then you have to kind of say, all right, I'm going to see myself through that kind of volatility to accumulate wealth over the long term. It's a different mindset than trading with a 2-day horizon.
That's a good That's a good breakdown. Also, inside that same move, you mentioned how much liquidity or not illiquidity, I guess, the margins that people have on this money, how highly levered it is. So when these moves happen, that kicks in the algorithms, and that can just where you see these huge moves. You just probably as investors just sit still on those days. I know we're running up on our time here. I want to ask you, what are you seeing 2026 that you already kind of anticipated, and two, that has caught you completely off guard with the markets in regard to the beginning of the year?
Well, I think the stuff that's hard, Marcus, I mean, we do a pretty good job of trying to figure out who could benefit from AI, who could be disrupted. Um, but I think you have to take the tact of, like, if a company has high margin, then a CEO is going to try to predict their employee and customer behavior and not pay that firm. So I'm not shocked when I see S&P Global or Gartner or MSCI or FactSet or consulting companies or software companies suffer because people are trying to get rid of them and they know they pay a lot to them. The part that's harder is when the president comes down and says certain things that impact, whether it's credit card caps at 10%, you see the credit card stocks go down, or when you see the stuff on tariffs or rolling tariffs and the metals move up and down a lot, or when you see stuff on the GSEs, so Fannie and Freddie, it was mentioned that maybe they have to buy back some mortgage-backed securities or whatever. When you get introduce volatility that way, that's hard to predict. And like, I've done a lot of meetings recently where people are saying, what industry could be next, or how do we get in front of housing? There was some comments about home builders and antitrust from the president a couple of weeks ago. Like, those things are really hard to predict because I think quantitatively we try to look at where estimate dispersion is narrow, where people have some confidence in the estimates, and some industries, that people had confidence in the estimates have gotten disrupted. So I think that part's harder. I think the AI stuff's hard, but not as hard. I think most institutional investors say, Taco, like the Trump always chickens out, right? So let's not overreact. If he does something that causes volatility, we can still stay the course. But I think with the AI stuff, I have the opposite view. If the multiples are coming down, it's probably because they have a higher probability of being disrupted. And so we let the price action inform us a little more if we think the volatility comes from something AI related than we think it comes from something policy related.
Got you. And on policy related versus AI related, you said you were meeting with your investors this morning, some of your clients. Anyone mention anything with Iran or the tensions in the Middle East right now because the geopolitical issues going on?
I think only from the standpoint of what it could do to the oil price. I mean, energy has been the best performing sector in the S&P this year. That certainly caught people off guard. We
Mhm.
took the 15 largest firms' year-ahead outlooks and stuck them in at Gemini and ChatGPT at the end of December, the 2026 outlooks, and none of those people, none of these experts thought that energy or materials would be the best performing sectors in the market. So, one, I think it is prudent to do the opposite of the bulge bracket firms consensus in a lot of cases. And two, I think the energy move has caught people off guard. And I think that's how people look at the risk there. We've seen so much geopolitical risk in the last couple of years, and the wrong thing has been to sell U.S. equities as an aggregate thing because of it. And we could say, hey, I'm worried about stuff, but I mean, a few weeks ago, a missile got pretty close to Western Ukraine, like to Europe,
Hmm.
to Eastern Europe, and the market was up that day, right? So I think people are in this sort of like, I don't want to. Worrying about geopolitical risk is it wouldn't have helped me make money or choose securities that much in the last 10 years, and maybe it will in the future, but it hasn't in the past. And so I think that's the mindset about it. I don't think there's panic selling about it at all. I think it's more, could it drive up an oil, a demand supply imbalance in oil, and what does that mean for input costs, or should I just own some more oil related securities? And that comes up, that came up a couple times today already.
Gotcha. Exactly. And inside of that, with the geopolitical, we see where countries and the tariffs and things just going back from last year, we've seen ex-USA, you mentioned that, outperform. These other countries are starting to invest in their own economies and make different trade deals and things that impact their government. They're starting to build their own defenses. So that's why you see when these missiles fly, those stocks go up, maybe perhaps part of the reason.
Well,
But
yeah,
good,
the European defense, people like European defense stocks, and they've liked them. And then same with the U.S. I think some of it's, kind of a government investment, and Trump's, view that these countries should defend themselves a little bit better. And some of it's, kind of where they are in the cycle. I'm on the board of, joining the board of later this year of a public European company, and it's been interesting the
congratulations.
perspective that Europeans have about the U.S. I think it's changed a little, and so I think it could cause some fragmentation in the US market versus non-US. I mean, people think the dollar's going to weak. Certainly, they've been pushing at our events we do more non-US equities over US than any time I remember in the last 10, 15 years, whether it's European defense, as you mentioned, whether it's the European banks, which have actually been better than the big US tech stocks in the last 5 years, whether it's Japan, or new economy China or Brazil or whatever. So I'm hearing a lot more non-US from people. I think if people are going to do that are listening, putting a small, small percentage of money in some sort of fund, EM fund or non-US fund makes sense. But I think picking individual stocks there for most people is not going to be a great risk reward.
Gotcha. Yeah, and another region, South Korea, when you speak about memory, that stock market did extremely well last year.
Well, Samsung and Hynix are huge percentages of the whole index, though. So it's like the same conversation about SanDisk, Micron, you know, or whatever. You got to remember, Hynix and Samsung are just massive percentages of the entire stock market there. So when memory goes up, the market looks good. But if and when memory rolls over, those stock markets will massively underperform. So that's just a levered memory call, I think.
What about Japan? You saw people speak of the Curry yen trade. I don't know if you can see where that played into your semis and trades, because that was a huge thing last year. I know I'm getting you pick your mind. You said you're 56 and go back in the time, but like Japan is outperformed as well. I know they're usually a country where the baseline is set for interest rates, right? People do see that as the
Yeah,
low.
I think that Japan's historically been about, the yen and rates. But I just think individual investors are seeing more on the technology side there, more optimism about, a shareholder friendly management team. So, again, if global MSCI is 65, 70% US stocks out of that 100, then if people are making like an equity allocation and they're buying a fund, I don't think it's imprudent to own 10 or 15% of their total allocation of Japan equities. That's not crazy to me. I've been a little more cautious on EM equities historically, just because a lot of them are more geopolitical, and so I still think somebody should own a pretty sizable chunk of their equity exposure in the U.S. But my comment was just more than I can remember. Institutional investors are favoring non-U.S. or thinking that it's not it won't be as correlated as it was in the past.
Perfect. Yeah, I know we're coming up. We got literally like 2 minutes, Adam. I appreciate your time today. If there's one thing you want to tell Main Street, tell them, and then let them know where they can find you, where they can see you, where they can reach out to Adam Parker.
Yeah, no, thanks for that, Marcus. And my view is, that the industry that I'm in is filled with incredibly smart, hardworking people that have tons of resources. So, you know, be humble about investing. If you make some money doing something, it's probably more luck than good. So try to be diversified and and don't take too much risk, because I feel like I see too much of that. And yeah, I'd love people to come to my website, www.trivectorresearch.com. Again, it's $100 a month. And we do we do monthly Zooms where people can ask me whatever questions they want. We publish 3 or 4 short 2-minute reads a week about what's going on, and we give people insights. So hopefully they'll find that valuable. I do CNBC once a week. I'm a CNBC contributor, and we obviously get quoted all the time in Barron's, Bloomberg, whatever. So you can see all that on our website. So thanks so much, Marcus. Pleasure to meet you. And, thanks so much for including me in your.
Yeah, man. Thank you so much for jumping on, Adam. And if you know anyone else over there, CNBC, Wall Street, who wants to come down, have a conversation, tell them I'm open.
Okay.
Seriously, that's like as serious as I can get about that one. Main Street meets Wall Street. We're bringing some Wall Street smarts with some Main Street heart. Just really excited to have Adam on. You're welcome, Adam, to come back on anytime and speak, about anything you like. You got an open invitation. Main Street, we'll talk to you next time. Thank you.
We just finished a high-level audit of the market's trajectory with Adam Parker. But here's the reality. Adam's great insights, as valuable as they are, they don't exist in a vacuum. They're symptoms of a system that has repeated itself for over a century. And he takes in all these factors when he does his research, as you can tell from the episode. What we just discussed, the hypersellers' dependency, the tariff volatility, the fragile sovereign floor, these aren't just phenomenons. They are simply the 2026 iteration of a pattern that has defined every major market reset since the Panic of 1907 and the Great Depression of 1929. Before we move into the tactical reallocation strategy for your own portfolio, we need to ground ourselves in the evidence. You cannot protect your capital if you don't understand the DNA of the crashes that came before. We're going to take in true Main Street meets Wall Street fashion and go into a deep dive of the history of Wall Street crashes, some of the symptoms, some of the things that we've done since to try to correct and marginalize them. If a crash like 1929 could happen again, and if this time is actually different. So that's a deep dive, a solo version, about 30 more minutes coming. One more thing, if you're finding this useful, you find value in the fact that we don't do the hype here, only data, this is the moment to support that work. Hit that like button. It helps the YouTube algorithm to get this intelligence to other allocators who are currently being misled by the mainstream narrative. If you want to remain part of this ongoing audit, if you want to be notified the moment we drop the next sector rotator report, make sure you are subscribed. We're building an archive of structural intelligence here that you won't find anywhere else. Take a second to do that now. It helps Main Street meets Wall Street stay independent, uncompromised, and dedicated strictly to this Main Street ledger. Done? Good. All right, let's check out the history of market crashes right now.
Main Street, Marcus Stern Sr. here from the markets right now. Dow Jones hitting 50K, bouncing around that level. We're going to talk about that. We're going to talk a little bit about the history of the Dow a little bit. Dow Jones theory, something that can show you why. We'll explain a little bit about that. And then also we'll talk about investing versus trading. It's a big topic. People use those terms interchangeably, and they are not the same. It's not the same. So just going to sit back a little more laid back tonight. Going to talk to you at Main Street, just let you know, help you come from one of my main missions. I help Main Street meet Wall Street. So we're just going to jump right in. Just jump right in. We've seen the markets just move crazy begin 2026. We saw a sell-off in software. It all started with Claude integration, right? Claude came out with an app with an upgrade to their tool that could do clerical legal work. And we saw services like LegalZoom and those stocks in those sectors take a flush last week. They just went down as we saw that AI could replace that sector, replace some work in that sector. Then we saw earlier this week, we saw disruption by Altruist and the integration of an announcement of their tool, Hazel. Full disclosure, me and my firm, BABC Squared, we use Altruist as our custodian. But that really, really shook the markets. It shook the financial firms, fintech firms. We saw Charles Schwab, we saw Raymond James taking really big hits after the release of Altruist. Altruist are true disruptors. Big shout out to Jason Wink and the team over there doing big things. You'll hear more from them. But one big thing with Altruist and Hazel's here to help advisors like myself serve folks like you all. It's a great tool. And we also saw earlier this week with the data that came in. So we saw data that came in, the jobs report, and revised jobs reports that showed that we actually lost more jobs last year than was reported initially. Once we got this data in, we saw the housing data was really weak. The stock market was just not prepared for that today. So it seems that we've been able to find areas to hide in. There are areas in the stock market that are growing, but today was just a really, really rough day for investors all around the globe. You gotta stay focused. You got to stay invested, okay? Don't go rushing. Don't go out making any brash decisions inside your portfolio based off one day, okay? 1 week or even 1 month. But we'll get to that later. That's investing versus trading, all right? So, like I said, so we're seeing this massive sell-off in the SaaS, software as a service area. So like I was mentioning earlier, you have areas like you have areas where software can replace paralegals or assistants. So we saw Salesforce and Adobe and companies like that just sell off. One thing to looking at is okay, so these AI agents will be able to come in and replace some of this work, but some of these companies that have stickier relationships, they have the data with some of these providers, they have large enterprise systems with these providers. I speak about the model and how this stuff actually works in an earlier video. I can put the link in the description where we go deeper into the SaaS apocalypse that just happened a couple weeks ago. But for now, just know that it was based on a model where revenue is charged per seat, and when you lose the seats, you lose your revenue. So henceforth, they see the revenue leaving Salesforce and their peers, not just Time Salesforce, but other peers, ServiceNow, other type of companies that provide services that can be eliminated by AI or AI software. So like I said, then we saw the altruist news. With the altruist news, we saw the move where people were worried about they won't need their financial advisors anymore. I think this is similar to, robo advisors when they first came out years ago. There were people who were worried that they were going to wipe out the financial advisory industry. These tools will revolutionize the financial advisory industry as well as other industries. And there will be people who will use AI eventually completely for their financial advisors. More power to them. But there are going to be people who value the tools and value that financial advisors bring, mainly the personal touch, the stickiness and deepness that we can go into the actual human relationship. These AI and these advisors won't realize when not to panic sell. They'll be trading like algorithms. Algorithm trading, that's a video for another time. So if someone wants to, if y'all want to hear more about algorithm trading, just let me know. Or drop a comment in the video below. But so, like I said, these AI tools will come in and integrate. You have to think back when Robinhood first entered the scene. Robinhood came into the scene as a disruptor, and they had free trades. And this was back when companies like Charles Schwab and Fidelity, they were charging money for a trade. Sometimes $5 for a trade. And for people who are making a lot of trades, this can add up. So Robinhood came in and dropped the floor. Everyone thought Charles Schwab and these companies would be destroyed, but these companies just adapted. They have very huge balance sheets. They have a lot of leverage to pull, and they have a lot of money under assets under management. So they have a lot of tools that they can activate. They adjusted. Robinhood is actually one of the companies that was hit the hardest with these fintech innovations, but that's kind of tied to crypto as well. Robinhood has been played as a proxy to crypto. So as you see crypto go up, you see crypto go down, you see Robinhood move. I actually have another video on crypto, Bitcoin. When I speak of crypto, I'm usually only referring to Bitcoin or the blockchain. The other stuff is just way too much to go into with it. Not necessarily a recommendation for crypto or blockchain, but if you want to learn more, there's another video that I've already went deeper into. I'll leave a link in the description. But for now, Robinhood, fintechs, tied to crypto. When you see crypto going down, you'll tend to see these companies going down. So we saw Bitcoin really get hit pretty much this whole year, pretty much since about October at the end of last year. It's been cut in half, like 125 to 60. And in that move, Robinhood stocks been hit really hard as well, especially in the last few weeks. So we see these moves, we see money coming out of fintech, these AI software stocks, as people are looking for things to replace them. Investors, money managers, they're trying to figure out what industry can't be impacted by AI now, right? We're like, what can AI come in and disrupt? What hasn't it already disrupted, right? We saw it hit the Microsoft and stocks like that. What has it not already hit, or what hasn't already been impacted? What's a safe play? So people think, I don't know, maybe a safe play. We see a lot going into industrials. Industrials are up this year, materials, things like that. Energy's up this year. So we're seeing a rotation. So the money that is leaving AI and software is not completely leaving the market. It's just being redispersed into different areas. We're seeing it going overseas. We're seeing, well, we saw it going into gold, but gold has kind of leveled off. As I said, you played, but we see money is being reinvested. A lot of money going into ETFs, just like indexes. But this is a time where stock picks will matter. You can't just go out and just say AI and think that you'll have a stock that's going to win. You have to know what you're doing, do your research, check the spending on these companies. The spending levels really matter. When you hear CapEx, how much are they spending on capital expenditures? How much money are they spending? And what's the return on this investment? ROI, return on investment. How much are they getting back for every dollar they put in? If I spend $1, am I going to get back $1.50? Am I going to get back $2? Am I going to get back 98 cents? I'm going to get back 98 cents for every dollar I spend. That's not a good investment. So people just wonder how much exponentially you're getting back for every investment that you're spending. You don't want to lose money on investments. And they also want to see, they're just interesting with the type of funding that's been going on with the AI move as well. We have Google that just introduced 100-year bonds. So I don't know who's going to be here for 100 years. Maybe these are tools that can be used for endowments or for, I don't know, a family legacy type investment. I'm not sure who's going to accept those bonds, although life expectancy is up. That's a whole nother topic. Not one I'm going to cover, life expectancy, but I can help you with how much money you need to have to live with this new expanded life expectancy as well. So it's just another thing where you may need to talk to someone. So talking about AI, software sell-off, the whole market sell-off that we're seeing right now, people are just worried that the whole AI play is flawed, right? So if the AI play was flawed, people are worried about the Mag 7 and the move out of software. We still see moves into semis. People are still making chips. NVIDIA's still getting chips. So some of those companies have seemed to perform well. Some of these chip companies have backing by the government as well. You could think of Intel and their partnership with the government. I do think of other companies that have made commitments to the government. And just know that there's a balance. These things are normal that we're seeing right now. You see markets go up, you see markets go down. These are pullbacks right now. So you see 10%, that'll be a correction. You see something going to 20%, that would be bear market. That's where you start to get to maybe recession talk, where people start thinking about those type of things. But we're not there. This is just a rotation right now, volatility. You never know what moves the markets from day to day. Never know what will move the market from day to day, I should say. It could be one tweet or one post, or it could be economic data, which is another thing that we've gotten. Like I said, it's coming in just lowering the chances of a rate cut, depending on which camp you're in, or some say perhaps we may have to have a rate hike if the economy is running so hot and inflation is out of control. We need to tamp it back down. We'll see. We also still have the tariff interplay. We have Iran, which is pushing oil prices up a little bit. So we see that increase in inflation. We see that increase in the oil stocks right now. Just a lot of moves aside. So the stock market right now, if you've been invested in, say, since COVID, you haven't really seen this. But this is natural. This is a rotation. This is what happened last year. I don't know if it's going to be the same duration. I don't know if we're going to have the same V-shaped recovery. But if you remember last year, at the beginning of 2025, there was a lot of economic detoxes. We had geopoliticians. We had to figure out if we were going to get the legislation enacted with the one big beautiful bill, tax reform. We had to see if the tax cuts would expire at the end of the year. We obviously had a government shutdown at the end of the year or in the middle of the year, and a later one, which we're kind of partially in right now. So there's a lot of stuff happening right now. And we have a debt and deficit that are just expanding. Interest rates are high, and the Fed they're on pause right now. They cut rates at the end of the year, 75 basis points, 3 cuts, but they're on pause for now. We have Kevin Walsh coming in, and that seemed to have routed the markets. That was also around the same time as the software sell-off. So those things happened on pretty much the same day. It was just a big shake with the market. What I'm saying is, what we're seeing is natural inside the market. We actually witnessed it last year, even as the market was up 18 to 20%. We saw rolling recessions in certain areas. We saw areas that were down, areas that were up. This brings me to my next topic. So I said you can kind of tell when these things are coming, right? They're moves, they're different theories, right? One is Dow Jones Industrial Theory. You hear people talk about the Dow Jones. All right, what is that? It's a stock index started by Charles Dow Edward Jones, another man, Charles Stressenberger. That's quite the name, or Bergstresser. Charles B. But so Dow was a journalist. Edward Jones was statistician. Back in 1896, they started this index with 12 companies that pretty much encompassed the U.S. Economy, different sectors. Obviously, as the world changes, the companies change, the sectors change that represent the U.S. economy. Right, railroads was a much larger part in there than it would be today. Dow Jones now has expanded to 30 stocks. So it's one thing to hear people speak about the Dow Jones all the time. It's only 30 stocks in Dow Jones, but it represents the total economy. And one big thing with Dow Jones is the Dow Jones Industrial Theory. So Dow Jones Theory, transportation theory. So inside of it, you have Dow Jones Transports. Part of the economy and stocks that move the goods. Other side, you have the industrials, the parts that are making the goods. So if the stock market, so let's take for instance where we saw 50,000 in the stock market, might be 50,000 now, depending on the time of this video that you're watching, but on the Dow Jones. But when it hit 50K, what we saw was the Dow Jones transports were down. So those companies were down. Why would they be down if the stock market's that high? Okay, so that's because they don't have things to move. There are orders being made and orders being moved, or there's something delaying the movement of those orders, right? So you need the transports to be transporting items. You need the industrials to be creating items and goods to be transported to the consumers. That shows that the whole cycle, economic cycle is working. People are consuming, producers are producing, transports are moving the goods to consumers into households. So when both of these things, when the industrials, the industries that are producing goods and the ones that are transporting them are up, and you see the economy up, like the Dow Jones up, stock market economy, two different things, but and you see the Dow Jones up, that lets you know that this is a more healthier move. So and what we saw recently was a state where the Dow Jones was the transports were and are in bear territory. It took a hard hit today. Most of them, FedEx had their investor day recently, and that helped them a little bit. But in general, we saw the Dow Jones investments or Dow Jones transportations have been in the bear market here lately. So think about, like I said, companies like FedEx, UPS. These are just some of the Dow Jones companies. So Dow and Jones, they would read the reports, take them to the New York Stock Exchange. That was your thing back then. That was how they started and just grew into what we know today. That's the stock market in the U.S. Or the Dow Jones industry. Another thing to note is that people worry about bubbles, and you should be concerned with your investments. You know what you're investing in. We've had several of these, have a lot of these. 1907, we had a big hit. The government responded with the Federal Reserve. 1929, obviously the Great Depression. That many people remember. Well, not living people remember, but we've read about the Great Depression, one of the greatest financial depressions in history. That was started by speculation and bank runs. We created the SEC. It was a lot of margin calls in there too. So we created the SEC after that to help with governance and regulations of traders, because the stuff that they were doing a lot was terrible. It wasn't illegal back then. All these margin calls, insider trading. Then you have 1987. So in 1987, you just have, also it was another incident where it was somewhat of a scare. People started kind of running on banks. You had a bad day on Thursday and Friday, and it just kind of carried on. But there were definitely underlying issues inside of the economy. We had run it hot for a while. The Reaganomics had run it very hot. So there were other actions inside that. Then you had the 99, 2000, 2001 bubble, which people like to compare this time to, where you had the dot-com bubble. Anything and everything that was dot-com was going up and going up and going up. Stuff that didn't even make sense. You had to build out. I was speaking up with the board group that I meet with earlier, an advisory board. We were talking about just the investment, the bubble, what people were seeing, what they're talking about with their clients. And I just mentioned, back then, people weren't really sure. They were really overbuilt, and well overbuilt for AI too. But they built, I think it's 5 times the amount of fiber that goes around the world. And actually, like with AI, we'll probably only end up building 2 or 3 times as much capacity as we need. Same thing happened with railroads. When railroads came out, we overbuilt railroads, which is ironic because now we're trying to get the railroads connected where we can have a cross-country transit. But that's a whole nother whole nother story. But so like I said, you have the dot-com where you have overvaluations, you have cheap money. It's also a thing that's usually custom to all these things is cheap money with low interest rates. So you have cheap money and the bubble bursts. You had a lot of things that actually didn't earn any money. You have things that just, like I said, just said .com and the stock price went up. Kind of like you just think about things that just said AI and the stock price went up. Then we have 2007, 2008, the housing recession that was built off of the those structured notes, those terrible mortgage-backed securities that were created. The movie The Big Short's a really good explanation of all that. But basically what they were doing is they were lending money to people who possibly couldn't pay back the bill. Let's say that you make $10,000 a year, they would sell you, and these numbers are arbitrary, not exactly real numbers, but the way that people couldn't pay them back or not. So say they would sell you something for, say you were earning $10,000 a year, they would give you a loan for a home that's $500,000, a $500,000 home, something that you couldn't pay off in 50 years if you wanted to. And they would just approve it because they were just trying to get those loans approved because they were catching fees on the backside. So they were taking these loans that were trash, packaging them with other loans that were good, people who were credible, people who would pay back their loans, putting them inside these notes, putting them all together out in there, and then going out and getting insurance on these notes, selling them to people. Sometimes they're also shorting the same notes, right? So they were playing both sides of the fence. They knew these notes were trash. They knew that the housing market was they knew that eventually the bubble would pop. They just were figuring out who was going to get caught with the bag. Who's going to get left with the bag? That was the question. So that's 2007, 2008, the housing market, and it was a terrible, detrimental time. And this time plays into a lot of investors now, because a lot of people who are investing now were children then. So they remember the stress and the pain that they saw from their parents or people losing their homes or not being able to move into their home. Another big thing with that is a lot of those loans they made to the individuals were adjustable rate mortgages. So in my opinion, and there are various opinions on this, you want to get a fixed rate on your mortgage. That way, when the interest rates go up or even when interest rates go down, your mortgage stays the same. These people are getting financed. Like I said, they're $10,000 a year paying for a $500,000 house. Maybe they got financed at 3%, but then interest rates started going up with inflation, as we saw, and these mortgage rates could just shoot up 1% or 2% in a month, 3%. I know people personally who just saw this same thing happen to them, so their payments would change like drastically, and then their houses weren't worth what they paid for them, so they were underwater. People would just leave their homes. So 2008, 2009, the housing market bubble was a terrible thing. A lot of people lost a lot of money, lost their homes, just probably lost relationships. It's a bad time. Then we get COVID, 2020, right? The world just shuts down. And that kind of stuff happens, They're just events that you can't plan for. It's always going to be one of those. They're just going to happen. World just shuts down. In response to it, the government stimulates the economy with a lot of free money at low interest rates, low to zero interest rates. People go out and spend this money. Inflation just begins to run wild. We do not catch inflation in time. Chairman Powell even said that they mistimed it and probably shouldn't use the word transitory. Although some of those things may be transitory now. Maybe they just had the time frame wrong on the transitory inflation. But so we saw inflation go up to record highs, levels we haven't seen in 20, 30, 40 years in the last few years. So inflation goes up like that, and your price goes up 20% on something. Even when inflation numbers come down in the following years, and they say inflation is 2.5% compared to estimates of 2.5%, people are happy about it. Inflation state, that's still 2.5% on top of whatever it already was. So people are feeling this pressure from prices. So inflation, prices, and then we just saw. So we're still feeling that bubble. We're still working through that right now because these things take time to recover. That's where we're at now. We're at the point where fiscal policy has to figure out we've been working on bringing inflation down, how to cap this inflation. Are we going to grow out of this economy? Are we going to have productivity that outgrows the inflation? We've had some tremendous GDP, but we also have tariffs now, so that's a whole different dimension than we experienced before. So inside of the tariffs, it's just get a whole different experience. You have a whole different level that we really haven't had a high level of tariffs, I should say, since the early 1900s. But we've had tariffs. President Trump enacted some tariffs before in his first term, and President Biden left those tariffs on. He just took the tariffs. President Trump has just taken the tariffs to a different level now. Another thing that can move the market is depending on what the Supreme Court of the United States has to rule on tariffs, and the tariff ruling that is imminent. We're expecting it soon. So that's just kind of how you get to these bubbles, kind of different ways, right? Some things are different inside these bubbles. One, the speed of information, right? So we have so much speed that moves inside information. Inside two is after all these moves, all these scares, these depressions, there were tools implemented to help curb future events. Some say they made them better, some say they made them worse, right? One of the things that like in 1929, the Fed was there, but the Fed made the wrong move. The Fed didn't. The Fed tightened monetary conditions when they should have loosened monetary conditions. So just because you have the institution there, they still have to have the people there to make the right decisions, right? So you had the Federal Reserve, like I said, in 1929, but it still didn't stop because they made the wrong moves. And hindsight's 2020. The Federal Reserve Chair at that time had never experienced anything like that. But here we are, 2026, coming into a new Fed chair and a new government in the middle of what may be a bubble, the end, the beginning. I don't know. We'll see. Stay invested is a big thing. So that just brings me to my next point. Investing versus trading. Way too many people just say investing and trading like it's the same thing. And it's not. Okay. So think about investing like gardening, farming, right? Like you got to plant the seed, Actually, first you have to go in there, you have to get your soil, you got to pull out the weeds, you got to get all that stuff right. Then you plant your seed, then you fertilize it, you do all that stuff, and you got to let it grow. You got to tend to it, you got to tend to it, you pull the weeds. When you first put it in there, you got to do a little more work, right? Before it gets established. Once it gets established, you just pretty much tend to it. It's a tree plant, you just go out and prune it maybe once or twice a year once it grows up to its maturity. But while it's growing, you have to make sure the trunk is stable. You have to make sure that things aren't out there. You make sure that that's messing with the tree. You just have to make sure that it's nourished. But as it grows, it can take care of itself a little bit more. So that's like investing. You want to take your time. You want to make a move. You want to invest in something. You want to have it. You want to make something. You want to buy something that you can hold 3, 5, maybe 20 years. I don't know. Plus, and I'm not just talking about investing in stocks or bonds. When you invest in anything, a lot of people invest in homes. Their homes is their largest investment. But yeah, I mean, you're not buying your primary home and moving out of it in 6 months unless you're a person who flips houses. But most people, think about it, that's an investment. You invest in your house or you invest in yourself, you invest in your education. And those are things that take time, those things that you put the work in at the beginning, you get the results in the back end. Investing. You invest in your relationship. You invest in a lot of things, right? So those are investments, longer commitments. Trading, on the other hand, is something that just happens fast. Boom, boom, boom. Trading's like speed dating, I guess. I don't know if that's still a thing. I guess I think the 40-year-old version, every time I think about speed dating, that was fun. But yeah, so those are like moves that you're in, you're out. I usually consider it less than a year that you can be in a trade, right? You can see something that you like now. It could be something that you like later. But a trade can be a minute, a second, a day, an hour, months, a year. It just depends. Depends on your time frame when you're jumping in, when you're jumping out. One thing I will say is that you should be knowledgeable in what you're investing in, and you should be knowledgeable of what you're trading in. The same amount of knowledge, whether you're investing something or whether you're trading in it, because it's your money both ways. So you need to know what you're investing in. What you're investing in, you need to know why you are investing in what you're investing in. What's the reason? Why am I doing this? Because the market's going to get choppy. Look at where we're at now. Don't go out making drastic moves. If you're an investor, you're not out making drastic moves in your portfolio right now. Maybe if you balance some, maybe if you reduced a little bit of risk, maybe you've gone a little bit less risk on, more risk off. I got a good video on that. I can leave a link for it in the description, risk on versus risk off. And you're just reducing your risk, you're reallocating some of your assets. But if you're a trader and you see this stuff, you're jumping in, you're jumping out, you could mistime it badly. You could get it timed perfectly and make a lot of money. Could. You see those people on TV, like the one or two who actually timed it perfectly and they like write books about it. But generally you see people who tell you don't try to time the market, especially with trades. Like, stay in the market. Time in the market dwarfs timing the market all day, every day. The longer you can stay invested, generally the better your returns will be. Why is investing going to, over the long run, work out better for traders? One, it requires a lot of time to trade. Time, effort. Unless your job is a trader, if you're a person who has another job, it's hard to trade and have a job and a life because it just takes a lot of time to watch the market, see how things move, especially in the markets we're in right now. The markets today, for example, the futures were up in the green to start the morning. Market is down a few percent, just a deluge, just a flush. I usually see when the futures are down in the morning, the market ends up. It's very interesting juxtaposed. But if you're not in there and you're watching the stuff, you can make the wrong trade. You could have bought this morning, sold this afternoon. That's not how you want to do it, unless you're short in the market. Different story. But mainly you want to invest, or if you want to trade, just make sure you have the time, make sure you have the knowledge, make sure you know what you're trading, make sure you know your why. So investing versus trading, just the basics of it. If you're using your retirement account, your 401k, something like that, you do not want to trade inside of that. That's just not prudent. You probably want to invest in that. Get a different pool of money for trading if you want to trade, but not inside your major retirement account. It's just prudent, right? Also, before you get into investing or trading, if we're talking about stocks or bonds, you need to make sure you have the basics set up. I got a video. I'll leave a link for it on the basics of investing, the blocking and tackling, the building blocks. I can leave it down in the description. But so here we also have it. So we talked about a lot here. Talked about the market sell-off earlier. Talked about Dow Jones, a little history on Dow Jones. Dow Jones theory maybe is one of the things that you can see. It's how you'll know if the market is going to move or if you know if goods are moving in the economy. Spoke a little bit about inflation. We did a little tour about the history of some of our economic failures, recessions, depressions. Some of the 5 big ones: 1907, 1929, 1987, 2000. 2001, if you want to call it, and then the 2020 COVID crash. I missed the housing market and the housing market. We talked about the housing market crash as well. So 2012 as well. So we covered all those, just some general things to remember when we're talking is remember that if you're investing, stay invested. These are opportunities. If you're a long-term investor, there's a stock or a bond, or even, I don't know, if you're investing in property like something you see come down that you think is going to be a better investment in the long run, take a shot. But know that anything you're investing in, you need to give it time to grow. It's going to ebb and flow. It'll go up. It'll go down. Eventually, it should go up and to the right. Right. Don't be intimidated by these stats and these numbers people are talking about. I'm getting some education about it. If the stuff sounds tricky, one of my main things, like I said, I do this. I help Main Street meet Wall Street, and I do that with just disseminating information to people. So you can check out my channel, subscribe, like, share. I'm here to share a little bit about what I do. Like I said, this is me by night, but by day, I'm a financial advisor. I have a firm up there at the HC Square, do financial planning. I love the markets. I love financial literacy. That's one of my big things as well. So if you need help with that, give me a shout out. Remember, the market sell off today. Know some of the reasons why. I know if you want to jump into some stocks, think about whether or not one of these AI stocks that we saw in the sell off can be disrupted and completely eliminated, or will it just innovate and continue to grow? Maybe those are the ones you want to invest in, the ones that will continue to grow versus the ones that will be eliminated. Remember the Dow Jones, 30 stocks, 1896, Dow Jones investment theory, the transports, watch those. And when you hear people speak about it, because part of my mission is to help people understand the stuff you hear when people don't want to go deep and diving into this information. Let me know what you want to hear on the street. I'll help you to the best of my ability. I will be bringing on other folks to chat with, and so there'll be some other conversations where we're going deep as well, sharing some other things. We're going to bring some guys on, talk about some crypto, just the markets, different things, some things that I want to give you the information so you can make your own informed decision. I'm not going to tell you what to invest in on here. That's what I do in the daytime. We can figure that out. Here's just giving away information for the masses, people who want to talk. Like I said, the data, we spoke about data, the jobs data, what that means, why people are thinking maybe or not we'll have more or less rate hikes, whether this economy is running hot, whether the economy is not. We didn't even jump into immigration and the role that it plays in this right now with the job market. See, that's another thing. Let's just take a second in that. Immigration in the job market, inside the job market. So typically you need a lot more jobs. We spoke earlier about jobs and the level of the jobs being revised down. But with immigration now this year looking to be a negative for last year, net immigration, you're losing a lot of jobs. A lot of immigrant jobs were filled up in like farming roles. So you have a lot of people out here producing your food. Those roles are gone. People who have to fill those roles that aren't being filled by AI are going in there at higher wages. So you're feeling that come through the immigration effect. You're feeling that come through in your prices as it costs more to get this stuff off the field from the farm to the table, per se. It costs more to get it from the farm to the table. And every little step, it costs a little bit more. We're all paying a little bit more in the process. So that's how immigration impacts labor one way. You also have a lot of people who built houses inside the industry, and a lot of construction jobs inside the industry. So now you're having to pay people more to do that as well. So you're going to see housing inflation. That's another reason why you see housing inflation. But housing is also a big part with demand. So we lack supply, and the demand is there when the interest rates are going to be right. People are worried about interest rates. That's a whole other tricky interval. Then we spoke about investing versus trading, difference, the moves. And lastly, I just want to share, like I said, Marcus Sturman, Main Street, Wall Street. I do have a partnership with Monarch Money. It's a tool. It's a budgeting tool, a personal budgeting tool that I use sometimes with my clients. We can work together. It's a good tool. They can use it. You can share it with your partner. You and your partner can share it and see your budget live and live in color when it's happening. You can share it with your financial advisor. They can log in as well. You can all take a look at it all in live at one time. It uses AI to help integrate. It's a great place to see all of your accounts in one place. Helps with can I afford to make this payment right now? Not payment, can I afford to buy this right now? Or should I wait? Do I need to move this money here or do I need to move it there? So it's a really good tool. I'm going to check it out on the desktop. It has a great app as well, which you want to set it up probably on the desktop. It's a good tool. So yeah, it's Monarch Money. I'll leave a link for Monarch Money in the description. If you use the link that I leave in the description, I can be compensated for that. So full disclosure. But Monarch Money is a good tool. The link will be for a discount. You can start a 7-day trial. You can get 50% off the first year. But once again, Monarch Money. So yeah, that's check out my channel. I've got a lot more stuff already on there, and there's a lot more to come. Marcus Durbin. There it is, my name. Firms the ABC Squared. What I do. It's right there. Got any questions? You want to chat? Got any video ideas? Share this with someone? Let me know. Check it out. I appreciate your time. Thanks for joining me this evening.
We've walked through the archives. We've dissected the 1907 panic, the 1929 collapse, the 1987 reset, and the 2000 dot-com bubble. You've seen the evidence. History is not a warning, it's a blueprint. The structural DNA for every crash we just reviewed is visible in the current hyperscale media. Mania. I don't know. The sovereign floor is shifting. The energy bottlenecks were tightening. We just had renewed strikes with between the U.S. and Iran and the Strait of Hormuz. And the disconnect between AI-driven CapEx and the real-world yield is wider than it has been in the last few decades. But knowing the history is only half the battle. You have to know how to play the positions with your capital today. We only looked at the depth. We only looked at the history of market crashes, actually high level. If you want to get deeper into it, check out my latest episode on Main Street Meets Wall Street on my YouTube channel with David Snyder, the mystery broker on CNBC. He predicted the market crashes, and he's calling for an AI market bubble. But for now, your direction and next steps, you need to look at your portfolio through the lens of the patterns we've seen tonight. If your exposure is built on the assumption that markets only go up, you are structurally vulnerable. Pivot assets or just cut back some of that exposure to some of these things that make parabolic moves. Continue to audit. This archive was the foundation, but the conversation is evolving in real time. To see how these structural lessons apply to current AI bubble specifically, like I said, I recorded a very intensive briefing with Mr. David Snyder. David and I spent over an hour and a half diving deep into the AI hyperscaler mania, exactly where the cracks are forming and how to rotate your trust assets before the market recalibrates. The conversation is the follow-up to everything we've documented today. It bridges the gap between historical patterns recognition and the 2026 tactical execution. Is this more economy what we're in? More things going to work? If you found value in this audit, hit subscribe. Check out Marcus Durbin Sr.'s YouTube channel. It's where we provide real-time briefings, different intelligence. Love to premiere live videos when things are happening. Ledger's open. The war for the Main Street economy is going on. We can't slow down. It's not slowing down. I'm Marcus Durbin Sr. Main Street meets Wall Street. Allocate accordingly. Let's get to work. Main Street Heart meets Wall Street Smarts. Thanks for listening.